Good morning, Dan Kautz.
Jeff Buckley.
And here we are in January, Jeff, 2026.
That's right. Happy New Year.
Happy New Year, buddy. I didn't have any signs. I should have gotten a hat and a little thing
That's
that annoys
okay.
me. No, you're okay? The pilgrim thing's still a little
Yeah,
scarring?
that's right. Yeah, got to recover from those props there in November.
So there's a little housekeeping here. As you know, we can't take any, we're recording, we can't take any live texts or phone calls at this time. Our contact information is dkautz@kautzbuckley.com. jbuckley@kautzbuckley.com. Our office phone number is 716-276-8480. The ever popular text line is 716-272-1129. Please, if you are going to contact us on a business question or anything, please contact us on the text line. Do not be texting our personal cells. I know we have a lot of family and friends that we work with, and a lot of times those calls or a text may slide into a business question. So please, use the business text when you need to talk business. Of course, follow us on Facebook and on LinkedIn. I think now I've plugged everything possible on the socials. Let's get into it.
All right.
It's the end of 2025, and we have some end of the year numbers here. So this was a nice piece to put together. We had a whole year to look back on.
We do, and it was a good year too. I think anybody that had an investment account really of any type, and we'll get to that in a moment, but even more conservative investments that might have been a little heavier weighted toward bonds still performed very well. And if you had some exposure to the financial stock markets, you really did well. So this just kind of shows, a couple of the different sectors. Really, the two columns I was kind of looking at that I thought were most interesting. We had very, very significant performance out of the Magnificent Seven that we've now been talking about for years. The Apple, Microsoft, a lot of the high-tech, very large companies, they did very well. And those tend to be reflected a lot in the NASDAQ as well. So you can see that's where the outsized growth was, but even the S&P 500, which again, we talk about this a lot, the Standard & Poor's 500, that is a broad swath of our economy. It's the 500 largest companies really across all different sectors. And the S&P 500 now it does include that Magnificent Seven, so it got some outsized growth from that, but really it was able to turn out a very good overall performance for the year.
And that also remembers, as we talked throughout the year in 2025, quite a bit of breadth here. It wasn't just the seven.
Exactly.
It was,
that's right.
Almost all companies were participating.
Yeah, which was a good sign for the markets as well to keep that breadth. Now, I mentioned the other column, the one over here closest to me. This shows versus the 52-week lows, which for just about all of these indices, that was right after the tariffs were announced in April. So in the span of roughly 8 months, somewhere in that neighborhood, we had the Magnificent Seven go up 74% in value. Now, a lot of us were, we work with a number of money managers, and the money managers were protecting portfolios after that tariff announcement and the drops in the markets, and then they started putting that money back to work in these investments after they saw the recovery begin. Very few, if anybody, was going to be able to hit that right on the nose and catch that full 74%. But the point is, even the S&P 500 up 41% from those lows in April. So again, what we talk about all the time, what we preach, stay invested. It's your time in the market, not timing the market. Because if you stayed invested, you rode through that turbulence, and you were able to come out at the end of last year with some very nice returns.
Yeah, no doubt about it.
Yeah, and this is just a quick look at the sectors too. Again, it focused a lot on this, the last column here, and the huge jumps, but it wasn't limited just to the communications, which also includes Google, the internet company, that kind of thing. So it's still a lot of very high-tech companies in these first two columns, and clearly some outsized growth there. But also look at industrials, look at even the financials overall in 2025, solid returns, and it'd go all the way down to the consumer discretionary, had some of the biggest bounces off of the 52-week lows. Right. So interesting to look at how the different sectors performed as well.
I think we skipped a slide.
Nope, that's it, because I wanted to just touch on
Got it.
2025,
I'm
yeah.
sorry, I was looking for the 60-40 and the 50-50.
Right, that's coming up, it's
Okay.
coming up.
Don't
But this
throw
was just
those
a-
curveballs at me. My job's to move the slides
That's
along.
all right. That's all right. But this is just a quick look and a little bit. Dan and I work, as our clients know, we work significantly with AssetMark, and they have their own team of investment professionals that really do a great job. And they provided us with a presentation, and I've kind of drawn on a lot of their slides for our presentation this month because I really felt they were very
solid.
good. Yeah,
were
very
good.
solid. And this is just a quick hit. Again, we're still kind of looking in that rear view mirror. How did we do in 2025? S&P 500, artificial intelligence and growth stocks, they led. But what was interesting, and we talked about in the last slide, the Magnificent Seven, only 2 of those 7 stocks actually beat the S&P 500. So again, we were seeing that market breadth, the spreading out of people investing not only in the Magnificent Seven, but those other 493 companies out there that make up the S&P 500. International value equities. So let's explain that just for a second. International, and again, this is a broad topic or subject here because international in this case includes really just anything outside of the United States. So you're going to have your developed countries like the European countries, Japan. You're also going to have some emerging markets in there. But the point is, if you went beyond our borders and then we focus on the value equities, so these are the stock of companies, but they're the value companies. And when we use that term, really what we're talking about are companies that are very well established, significant cash flows, but they also quite often, in fact, almost all the time, are paying solid dividends. So you're earning an income while you own the stock of those companies. And they actually, in fact, AssetMark used the word thrashed. They actually thrashed the U.S. growth companies. So we had it for years before. We were almost avoiding the international markets because the growth in the United States was so outsized as compared to the growth beyond our borders. But this past year, it kind of flipped that on its head.
And this also has a lot to do with the value of the dollar versus other currencies.
Exactly, yes.
So as the dollar loses its value, which it has over the last few months, internationals have been looking much better.
Right.
And that will probably be the theme for a little while longer.
Yeah. Just another note here, gold. We don't have a lot of gold bugs that we work with. There's some people that focus primarily on investing in precious metals, especially gold. We usually will include that, or our money managers we work with will include that as maybe a small portion of a lot of portfolios for further diversification. But those small portions were very beneficial over this past year. Gold had its best year since 1979. So just an interesting tidbit there. So we'll get back on track here. There it is. Yes. This is, again, we looked in the rearview mirror. Now we're looking kind of out the windshield. This is the current state of affairs here as of January 8th. Just thought we would note that as we record this, we do not yet have a decision from the Supreme Court on President Trump's tariffs. We're expecting that here within the next couple days, really. So that will have an impact on the markets. But up until now, what we're looking at here, and again, the first column doesn't mean much at this point. We're still just a few days into the new year. But going back 12 months is almost an exact one-year return. And very interesting. I find it very interesting in the sense that, if you were a more aggressive investor, that paid off last year. 80% allocation to equities or stocks, 20% to fixed income. You had a very solid return. In fact, that does beat the S&P 500 return for that same period of time, which is about 17.9%. But if you look, even the most conservative allocation, which again, this is going to be more reflective of how your individual portfolio is set up. If you only had about a 20% exposure to stocks and 80% to fixed income, you still had a double-digit return for last year. And we've been able to really expand our portfolios. And the money managers we work with are taking advantage of the great returns in fixed income. Now, how long will that continue as the Federal Reserve continues to lower rates here over the next 12,
12
18 months, yeah.
We got a lot going on in the Fed in the next
We
couple
do,
of months.
we do.
next
So
couple
we'll have
weeks.
to see how that progresses, but it still was an interesting return. Now, if you spread that out a little bit, you start to then to see we're bringing in prior years where the performance of those more conservative bond investments wasn't as good. So when you go out 3 years, it becomes a much more drastic difference. And in 5 years, I mean, we're still at a negative number if you were overweight to bonds.
Right.
Yes, so that's it. But that's kind of where we stand right now. So this is, what's coming up. We like to take a look at these speedometers that are put out by, and just a quick note, City National Rockdale, still the same company out there. They're just now calling themselves Rockdale.
Right.
So that's why if you're used to watching these webinars, we used to refer to it as the City National Rockdale speedometers. Now it's just Rockdale, same company. Same speedometers.
Just felt they hired a Madison Avenue magic.
Yes.
Let's change our
exactly.
name and the world will be different.
That's right. That's it. So, and Dan and I always like to look at these and see, where do we stand? How much red is actually on the screen? And quite frankly, we're down to just one red speedometer. So we're back where we were almost a couple years ago, when we had quite a bit of green. We've had a couple things shoot up. Corporate profit growth. We kind of cleared that fourth quarter. We're going to expect significant growth reporting when the companies start to report how they did in the fourth quarter. But with the 3 prior quarters and seeing how the year finished, most estimates, if not every estimate out there, is showing that corporate profit growth is almost accelerating at this point. So we're doing well there.
I'm feeling pretty good about the yield curve. The bonds are always the health of the market. The housing went down a little bit.
It did.
Affordability, that's that big buzzword that's going on, and not buzzword, reality. It's a reality. But when we look at this stuff and we look at a lot of our indicators and numbers and things, it's important when we think about what's going on. We can't act emotionally with our money. We got to follow the numbers, keep going north, keep following the numbers. The corporate profits, that's great. Consumer spending, still good. We still have strong numbers to follow. So keep following the numbers, keep invested, and keep moving north.
Right.
All right.
So again, and even Rockdale in putting this together, they're optimistic for the next 6 to 9 months down the road and where our economy currently is. So this is, again, I touched on it earlier, this is that asset mark presentation that they had put together. And these were the 3, they were taking a look out the windshield down the road now. What's coming over the next 6, 12, 18 months? So the 2026 Outlook, they identified 3 key themes, which I thought were very important. Artificial intelligence spending, how's that going right now? Policy uncertainty starts to fade, and monetary and fiscal stimulus. So let's touch on those 3 things. Just a couple charts to kind of give everybody an idea. Where are we on the artificial intelligence spending? The United States is leading the pack significantly. And the good news is that this spending is coming from companies that themselves are generating significant revenue. So again, we've made some comparisons to where we were with the dot-com bubble back, in the late 90s.
These are producers of product. These are people that have revenue income, and they're spending on the AI, which is only going to better and make their business more robust.
Yeah, definitely. And that's what's showing it. And we are concerned about China and the developments that they're making on a geopolitical stage here. Obviously, other countries, same thing. We believe we have the leadership position right now, and we want to maintain that. So we're spending, but if you look in comparison, it's not even close, really, with the spending that is being put into that. Artificial intelligence CapEx remains low in GDP terms. So again, this is more of what it's showing is this is kind of a favorable chart. So what we're saying is we're spending a lot of money on building out all aspects or all facets of the artificial intelligence. However, it's not to a point of our total gross domestic product that we need to be concerned. Look at railroads back in the 1860s. Now, that was the United Kingdom, but they were spending almost 5% of their gross domestic product on railroads. We're basically about 1% on our build out of the complete artificial intelligence
And
infrastructure.
then on top of it, yes, we're spending the money to build it, but what's the outcome? What's going to be the added GDP?
Right.
You know, what's going to be the added benefit
Oh,
after
yeah.
it's all been put
Productivity.
in? And, yeah, the productivity
Yeah.
moving up. Good?
Good, yep. So the next one, another chart here, it just showing also that the
Companies.
spending is continuing and it's continuing to grow. And so we start down here, this is 2025 estimate because the numbers weren't finalized there. But moving into these last two columns, 2026, 2027, obviously estimates at this point, but this is based on promises that companies are making, saying, yeah, we're going to spend that in 2025 or 2026. We're going to spend that in 2027.
It's in their budget. They're ready to go.
Exactly. So it's accelerating.
Which this equates to how does it come down to your dining room table? It's back to those sectors you looked at, the communication and technology. We're still going to see the spending. We're still going to see that push into our economy. We're still going to probably see that growth
Right.
in the market. And
Definitely.
it's good, but we want to keep an eye on it.
That's true.
Let's not get too into a bubble.
Yes. Now, here was some risks that were identified, the artificial intelligence adoption, and then also infrastructure. There's limitations kind of built into the system. That's our infrastructure. So what it's showing, the chart on the I guess my right there, would be the information sector of our economy. And this is, I guess, where you would assume that most artificial intelligence is being adopted and employed, and where the productivity gains, we're starting to see the tip of the iceberg there. But what it's showing is that there's other sectors of the economy that have almost no exposure, as of yet at least, to artificial intelligence. So it's going to be very interesting to see how this does start to kind of flow through all the different sectors of our economy, really, and what influence it has. And over here at power generation, artificial intelligence requires a significant amount of power, and having the power generation, we're not anywhere near where we need to be for even the promises that some of these companies are making over the next couple years. So that also means that another sector or two or three of our economy that focus on infrastructure, construction, and power generation, they're going to benefit as well, because there's going to be capital flowing to those areas just to build out this complete infrastructure. So again, positives, but things to watch for too. So now this is a little bit of a shift to their second theme that they pointed out about the policy. What's coming out of Washington, what's coming down from even state and local and municipal governments here. The policy uncertainty is starting to fade a little bit, and that's some positivity. Now there's things that keep coming out, but the tariffs, as we move into 2026, the tariffs are going to become less and less of an issue, because we're going to get, first off, we're going to get a Supreme Court decision and see if they even remain in place. But even if they're struck down, the thought is that the administration is likely going to find another avenue to keep these tariffs in place, because they feel they're positive in their trade negotiations. So regardless of that, we're starting still to get some certainty on what was a very uncertain situation back in April. DOGE, we had that right out of the gate. There was the promise to reduce the spending in the government. That's kind of faded away a little bit now. So, and then some individual tax cuts. Now this is starting to pick up a little. There's some green areas in there too. Deregulation, corporate tax incentives. So essentially, why don't you jump to the next slide, because essentially what they're trying to show here, I'm sorry, this just is focused right on tariffs. And they mentioned the Supreme Court decision.
Do you want me to do that?
Yeah, go to the next slide there. No, the next slide, because really what they're showing here is the markets look favorably on some of that uncertainty starting to fade away, and some of the tailwinds, the tax refunds, the
uncertainty going
right, the deregulation, those are becoming tailwinds, and they're starting to push this economy forward. So that's seen as a positive if that continues. And then the next slide there, we definitely have some geopolitical risks, and I thought this slide was very interesting, because this really brings home probably the biggest concern that came out of I don't know, the last 6 months of geopolitics here, really.
Negotiations
Yeah.
over the
Well, yeah, what
uh,
it shows is rare
earth
earths.
metals. Yeah.
That, I mean, those are required by many, if not all, of our high-tech industries. And specifically magnets. Magnets are extremely important, especially in self-driving vehicles, electric vehicles, that kind of thing. So what this shows is where China has certainly gotten an upper hand with us. We produce about 10%, or we mine about 10% of the world's production of rare earth minerals, whereas China mines almost 60%. So they're able to use that as leverage over us. And that's why when you hear that the U.S. is, the government's even taking some part ownership in companies that are focused on rare earth mining. So that's a sector of our economy that is probably going to grow significantly with some government assistance in there too, but it's seen as almost a national security issue for our defense industry. And then you've got rare earths refining. So you dig them out of the ground, that's one thing. And finding the deposits and then accessing the deposits, that's very difficult to do. And not every country has the deposits, that kind of thing. But once you've identified them and you've got them out of the ground, then you have to refine them. And China has the absolute lion's share of refining capacity for rare earth minerals and is becoming the global supplier, and there's really almost nowhere else to go for that. So I think the fact that that's been identified, it's certainly going to take a long time to try to eat away at these large sections of the pie here that China currently monopolizes. But we'll get there, I think, eventually. Hopefully, but it means
one way or another.
Yeah, but it means spending, significant spending in those areas to build out that infrastructure. So, and then this was more of a focus on monetary policy and fiscal policy. So this is the third theme that AssetMark identified as we kind of move into next year, or this year actually, 2026. It is showing that we are running into a problem on consumption, because if you look at our economy, the lion's share of our consumption is by the top 80 to 100% of our income earners in this country. So you might hear referred to it as a K-shaped economy, where those below a certain income threshold are having a significantly difficult time just making ends meet, and so as a result, their consumption is shrinking. Whereas if you're above a certain income threshold, you're able to absorb some of the price increases that we've seen much easier, and you can keep up your consumption. So it's interesting. That's something to watch, something we're concerned about. The other thing that really could be even a bigger indicator of difficulties with the economy is kind of a slowing in the momentum of our labor market. Now, as we're recording this, we've got some new numbers that are coming out. The numbers we've had over the last couple months have been really tainted because of the government shutdown, but we'll see where this all goes. But truly, if it does look like our labor market is starting to slow down, that moves right back into that first chart, because if you don't have a job, or you're not getting a pay raise at your job, you're not consuming.
Sliding down.
Yeah, so we want to see some stabilization in the labor market and an increase there too. So again, that's something to watch. It's a theme for 2026 to see how we get through this. I think, let's see here. Yeah, this is just kind of talking about fiscal stimulus. One of the things that a lot of economists, I have to say, I've been hearing quite a bit about this lately, have been kind of pinning some hopes to for a re-acceleration in our economy, is tax refunds. There was a revision of the tax code. It sounds favorable. It kind of remains to be seen exactly how much more money that's either going to leave in people's pockets or put back into their pockets in the form of tax refunds. The thought is it's going to be a fairly significant amount of money, and we're Americans. If we get money, we'll spend that money if we get it. So
run out to dinner.
Hopefully that what they're talking about is a little bit of an acceleration there in response to these tax refunds. That will remain to be seen through over the next 4 or 5 months as we all file our taxes. So keep an eye on that. This is the last slide, though. I just wanted to show, this is now focused on what the Federal Reserve is doing. And certainly if you've been following the news, we've got a Federal Reserve chairman that is, his term is up in May.
Yep.
Yep, we've got another one that's being appointed sometime by President Trump. The Board of Governors, there may be some other seats available. How independent that Federal Reserve remains is a significant question. But all of this kind of focuses on, if we get a rate cut, seeing a slowdown in the labor market, a slowdown in hiring, that tends to prod the Federal Reserve to look toward a rate cut. Slowing consumption is something else that will do that, and cooling housing activity. They want to lower rates to try to stimulate the mortgage market. So those were all things that might persuade the Federal Reserve to stay on their current course, although it's not very aggressive, but kind of their current course of leaning towards lowering the interest rates. However, there's arguments out there to refrain from any more rate cuts because we've got still, I don't know if I would call it rising inflation at this point.
Hanging around inflation.
Yes, it's sticky. And we need to conquer that. We're not anywhere near their target of 2% at this point.
Inflation is kryptonite to our economy.
Exactly.
So beating that down is crucial.
We've got that, and then the economic resilience. If in fact we start to see a real reacceleration of our economy, that's great news. That probably means that the Federal Reserve will not keep cutting rates, but we may not need them if the economy reaccelerates.
If you remember looking back at the speedometers, there was one on the bottom that said accessibility to credit, which has been green. Accessibility to credit reflects directly on the interest rates.
Right.
Lower the rates, the easier it is to get the credit, and why that's important is that's what moves small businesses along.
Yeah.
So looking good so far.
Right, yeah, so that's it. So those are the themes to kind of keep an eye on. We'll be continuing to put out information. If you have any questions, concerns about anything you hear in the news or how's this going to affect, give us a call anytime.
Hey, Jeff, I want to thank you every time. You're the guy that really puts these together.
Well,
and
thank
you
you.
carry, as you can tell, you carry the theme, and this was a lot to get done.
Yeah.
And there's a lot to talk about in 2026, but we're here for you guys. Give us a ring if you have any questions. Again, thank you very much. Happy New Year, and we'll see you next month.
Thank you.